You said that I think the current model is based on leasing and is slightly asset light. So what will be the implication if the model changes on the returns ratio or margins or whatever?
So currently what the company here to present our equity research findings on Thyrocare Technologies Limited under the healthcare services industry. So we go to the industry analysis. So the industry has been split into 3 different verticals. So we focus more on diagnostics, which is growing at a rate of 16 to 18%. There are the 3 criteria under which they are divided. They can be urban, rural, or regional or pan-India, imaging or pathological. Next. So next we will go to the demand drivers or the demand and supply gap. So there has been a considerable growth in the healthcare trends, movement of regional to pan-India chains, and then emphasis on doctor referral network and finding niche for your own products. And since Thyrocare has made a substantial investment in this sector through its subsidiary nuclear healthcare, which it is very important to know that this is growing at 30-35% growth, and then this is because of these 2 factors and can be classified as risk exposure and gap analysis.
So let's go to the business overview. So these are the 4 brands under which this company operates: Thyrocare, Arogam, Nuclear, and Waters. So these are the tests that is being offered at this particular brands. So Thyrocare and Arogam contributes to 86% of revenue, which is the major part of them. So this is how the business model operates. They are the ASPs. They deliver samples to the regional processing laboratories and central processing laboratories. And then the central processing laboratories conduct the test and deliver the reports to the ASPs. So this is the delivery cycle of this particular company. And then they have this CPL at Mumbai, the 6 RPLs. At present, they are commissioned the next RPL at Bangalore. And so these are the number of authorized service providers and where the obligations is present over there. So they collect the samples in barcode and standards files. So ASPs ensure that the samples is getting delivered by the end of the day. So there is a number of samples processed. There is a number of tests that has been done has gone at a CAGR of 30% over the past 5 years. And then the RPL, they are planning to increase from the present 6 RPLs to 20 RPLs by the end of 2021. So it says that currently the company is growing. So if you look at the Nuclear Healthcare, it's a subsidiary, and 47% of this particular company's equity has gone to this Nuclear Healthcare company, and it generated only revenue of 15 crores, which is only 6.2% of the consolidated revenue. And if you look at the cost structure of this particular company, their expense is rent, which is the highest expense, and then the second one is raw materials, and the third one is legal charges, which again goes to the promoter group back. So the rent expenses is paid to Sumati Constructions, which is again the promoter group, and then the cost of raw materials to Thyrocare, and then legal charges again paid to Sundar Raju, who is the promoter of this particular company.
So looking at the financial analysis, the company has nurtures about 3 times as big as Thyrocare. And these are the margins. EBITDA margin is very high for Thyrocare because the cost of employee is not been incurred by the Thyrocare Technologies, because the authorized service providers are independent agencies and they don't come under the payroll of Thyrocare Technologies. So their EBITDA margin is quite high, and it is expected to be at above 40% over the years in the future. And ROC is declining because they are investing in RPLs. Due to the increase in RPLs, the capital assets are high, and that's the declining trend in ROC. And this is
found out that Thyrocare intrinsic value is around 1805 crores and NHL intrinsic value is around 51 crores. So the total intrinsic value of the company as a whole is around 345 rupees. We have assumed that the next 5 years is going to be the high growth period for Thyrocare, where it will be growing at 30% rate, and the terminal growth rate we have assumed it to be very aggressive at around 15%. For cost of equity calculation, we have used the CAPM model, where we have found out the RE to be return on equity to be 10.6%. Since this company is a mid-cap stock and the liquidity of the stock is very low, that's why we have added size, value and liquidity premium, and the rounded RE has come out to be 21%. The company is not going to take any debt, that's why the weighted average cost of capital is also going to be 21%. Using financial modeling, when we discount the future cash flows, we found that the intrinsic value For Thyrocare standalone,
in NHL Limited. Just before 4 months before IPO, they offloaded a significant amount of shares at just 210 rupees. So 210 rupees is a very large amount when it's compared to NHL, stating the fact that NHL has been making loss over a past period, and it's accumulated loss of over 22 crores, and it is not expected to make profit over the near future as well. And preference shares were actually allotted to promoters of Thyrocare at rupees 305 per share on December 2015, which is again 4 months before the IPO. The IPO price band, considering the fact that it's 420 to 446, acquiring shares at 305 seemed a little bit fishy for us. So we actually found that the promoters of Thyrocare could be making a personal wealth at the expense of general shareholding community. And
It's about the corporate governance issues.
Sir, our same recommendation is based.
Could you just spend some
liquidity of the stock compared to outstanding shares is very low. That's why we gave a liquidity premium of around 2%. And since it's a mid-cap stock, that's why we have given a value premium of also 4%. And it's a value stock. For that also we have given a 4%.
in the immediate future.
basis have you put a value premium of 4%? See, CAPM is based on beta, based on market cost of capital, and therefore you arrive at I can understand your liquidity premium as well as your market cap premium. I cannot understand your value premium.
At a higher rate.
That means you are double counting. There is a risk of double counting that you have done because you do not decide whether it is overvalued or undervalued a priori.
One more reason is that, sir, this particular
And your cost of capital, and you discount your cash flows divided by the cost of capital. Your cost of capital can vary from person to person. One is the market cost of capital, and then the risk premium that you attach over and above the cost of capital. I can understand your size and liquidity premium that you are trying to include, but I cannot understand why you have decided that it is overvalued, therefore you should, so obviously it's a circular argument.
One of the reason is that, sir, the other comparator, which is the null path lab.
No, that is immaterial. When you start discounting cash flows, it's an absolute analysis. Cash flows are absolute and your discount rate is based on your risk assessment, not on a relative whether Lal Labs is X or Fortis is Y or whatever it is. That is immaterial. What is the risk and what is the cost of capital that you have included? So I am not able, it seems as Janaki said that you have decided to put a sell and you have built up an argument in favor of that.
Actually, sir, we have assumed aggressive term.
How did you arrive at the figure of 14%? I understand your logic and where you are coming from, but how do you quantify it to a particular number? The question is that.
So actually we considered a value that has to be, this should have, a cost of capital subsequently higher than Thyrocare because of the industry that we find
Down. Can you just go back to that slide?
To begin the presentation, Thyrocare is one of the leading diagnostic companies in India, and we are going to have a buy recommendation on the stock with the upside potential of 4%. And these are the justification points for that. The first one is that it has got a lion's market share in the industry. The company is able to generate 54% of revenue from wellness and preventive segment, which is expected to grow at the CAGR of 25% over the next 2 to 3 years. And the second point is that it has got the highest operating efficiency. The company is able to achieve a turnaround time of 6 to 8 hours when compared to the competitors who are taking. And the fourth one is the operational diversification. The company has ventured into different business areas and different areas of servicing, and this will act as a natural hedge for the revenue. And fifth point is the strongest financials. The company has tremendously grown over the years, which is margins set well above the competitors. Coming to the investment negatives, it has got the first point is that the company is too much dependence on the promoters' expertise. So So down the line, if the promoters, if the company is exempted from the service tax, if in future if it is brought under the ambit of service tax, then it will affect the bottom line of the company. And the third one is low barriers to entry with higher competition. If better players comes into the market and it will start eating into the market share of the company in the future. And fourth point is inexperienced ASPs. This company follows a franchising model of business, wherein it will have a relationship with the ASPs. In case if it has a tie-up with the nascent and inexperienced ASPs, then it could tarnish the brand image of the company if the ASPs does not comply with the code of conduct of Thyrocare.
Which is incorporated in 2010, they launched Arogyam program under the preventive and the healthcare segment, and in 2013 they increased their stake in NHL, and in 2013 they launched an equipment which tests water sample under the brand name of Water. Next is, these are the 4 brands of Thyrocare. One is Thyrocare, second is Arogyam, third is Nuclear, and the fourth one is Water. Now these are the product and services offered by the different brands. Thyrocare is towards the diagnostic testing, Arogyam is towards the preventive and the healthcare testing, Nuclear is towards the cancer and the full body scan testing, and the Water is towards the water sample. This is the hub and spoke model. So what usually they do, the ASP collect the information from the hospitals or the local individuals. They pass it to the either to the RPL or the hub, and they run the test and upload in their website. If RPL is not able to run the test, they pass it to the CPL. Number of CPL is 1, that is the India's biggest automated laboratory. Number of RPL is 6, which is till financial year 16, and it is expected to increase to 20. Number of ASP is 1041. This is the ESG framework. As you can see,
industries, out of which our focus will be the diagnostic industry. It is divided into organized and unorganized sector. The organized sector has contributed to 52% of the revenue in past financial year, and the unorganized sector has contributed to 48% of the revenue. The unorganized sector includes the standalone diagnostic sectors and the hospital-based diagnostics. Now the diagnostic industry has grown at a CAGR of 16% in past 5 years. It is expected to follow the same in next couple of years. Now coming to revenue drivers, first is the lifestyle-related disease and increasing health awareness. This has led people to move towards wellness and preventive segment. As we can see that it has contributed to 6 to 8% of the revenue in 2016, and it is expected to grow at a CAGR of 25%. Next is FDI and the government policies. Because of 100% FDI in the greenfield and brownfield projects and improved government policies, there has been tremendous increase in the investments in the automated diagnostic equipments, and this has led to the growth of the industry. Next is the changing demographics and increase in the disposable income. Currently, the per capita
average number of samples processed per day has increased at 20% CAGR in the last 4 years. Thyrocare is able to achieve this operation efficiency due to night-time processing and robust IT infrastructure and advanced automatic process. And test conducted per day has increased at 30% CAGR due to this price distributive strategy. And the company is following franchising model, so it is expected to increase its B2B segment in the following years. After being acquired by Thyrocare, Nuclear has increased the scans performed 6-fold in the last 2 years because of its less price. Because of the revenue drivers, the sales has increased at 25% CAGR.
As automation in place, and it was able to achieve a quick turnaround of 6 to 8 hours when compared to the competitors. We feel that if a better player comes in and eats into the market share of the company, we assume that the market share of the company will
be operation ability and market risk. Operation is already covered in the second slide in detail. And this is the relative risk. Company has some cases proceeding again in the courts. If something was wrong in the future, it's going to affect the brand name of the company. If we talk about the market risk, the inflation is around the 4% currently, but in the future, if inflation will increase, it's going to do 2 things. One, a company has to charge the more price to the customer, it can negatively affect the company. Second thing, company has to provide some more real returns to the shareholders. And from all the analysis, we can say that the benefits had outlaid the risk, so we have gone
for the next 5 years. The capex remains same as, let's say, the last fiscal year. So, haven't you checked this quality of the assumption? How can a business grow at 25%? This is the first 5-year period without any increase in capex. This is not a perpetual motion machine.
No, they are actually making some investments in the capex.
So why is the capex not increasing in your assumption?
The capex is increasing, so that is
Go back to your DCF.
So it's all going to be flat, around 120 to, and regarding the increase in the 25% growth rate in the short term, in the 5 period, we are assuming that companies follow the price distribution strategy. In this company are more and more focused on the less price, from the less price to take up more and more the customer, take more and more customers.
Your account receivable ratio is going up from 32 to 45, which is an incredible achievement for a company which means that its account receivable is kept static in absolute rupee terms, and all incremental sales are therefore achieved at 100% collection efficiency. Similarly, your total asset turnover ratio has jumped from 0.57 to 0.63 to 0.67. It has never achieved this ratio in the past as per your data. Consequently, it means for all the risks that I take in the equity market to put money behind this instrument, Thyrocare, or will that 4% I can earn it in putting that money in savings bank account, which is guaranteed by government of India?
If you are not willing to take any risk and if you are a risk averse investor, then you can go for equity. But if you are willing to take some risk, then investment in equity.
But there should be adequate return for that risk.
This is since we are considered only Thyrocare as a standalone entity, we are getting the upside of only close to 4%. This is because they are not able to realize the gains that
in the future.
I think the question was there are
paying less income tax for the last 3 years. There are details about that in the annual report. The numbers, just the numbers.
India, and I have reasons to believe so. India, despite recent blip, is one of the most fastest growing economies in the world right now, expected to grow at over 7% this year. Also, the inflation rates has been low, with the retail inflation hovering around 3.63%, thanks to good monsoon and falling crude prices. Also, the short-term lending rates and the low bond yields have ensured easy and cheap access to capital for Indian companies. And finally, with a 1-year forward P valuation of 14, Indian equity market remains one of the most attractively priced destinations to invest. With this, let me introduce you to our company, Thyrocare Technologies. Thyrocare, headquartered in Navi Mumbai, is one of the largest diagnostic chains in the country right now. Started off as a moderate thyroid testing unit, it now boasts over 198 profile tests and over 1041 service centers. Also, with its recent foray into the preventive and wellness care segment under the brand name Aarogyam, it now delivers stupendous performance with 52% of its revenue coming from the brand Aarogyam. Needless to say, if we see the story in charts, the revenues and the number of samples processed has constantly shown an increase, giving it a healthy PAT margin of over 20%, which is one of the best in the industry. One may argue that the expenses have risen and the return on equity has fallen in a minor blip, but this comes at the back of strong growth in the number of RPLs and service centers.
Over the last 10 years and are expected to grow at a CAGR of 8%. Healthcare expenditure in India lies abysmally low at 4%. It is expected to rise by 8% due to government focus on this particular sector. Rapid urbanization or favorable demographics with a huge segment below the 30-year barrier, along with an increased awareness, is expected to drive spending in that particular target segment that we are talking about. Changing disease profile means that the segment is already deriving 6 to 8% of its revenues from segments like oncology and others, which are very sensitive. Now let me tell you why this is sensitive. This is because you cannot delay these tests. These tests have a higher ticket size and there's a higher probability of repeat testing happening in this particular domain. Organized operations mean that the diagnostic chain have captured around 63% of the market, and this is why we expect it to hold on to its margin since it's a low cost leader. Overall, the industry is expected to grow by 16 to 17% and reach 600 billion by the end of next year. Looking at the financial analysis, you can see that there was a minor blip in its margins over the last 2 years. What is due to its focus on the wellness through its Aarogyam brand.
Since most of the market in India is held by unorganized players, the Thyrocare's major competitors are SRL Diagnostics and Totolal Path Labs. Both these players have their own large number of labs and collection centers, as well as they target the preventive and wellness care segment. For purpose of Thyrocare differentiates itself with focus on far fewer labs and focus on the large chunk of revenues coming from a preventive wellness care segment. Apart from that, its major customers are B2B, vis-a-vis B2C. For purpose of peer analysis, we took three major competitors: Fortis Healthcare, which is a chain of super specialty hospitals; Narayana Healthcare, which is a chain of 20 hospitals and Cancer Institute; Apollo Hospitals, which is again India's largest hospital chain and pharmacy.
Unique value proposition of low prices, ability to handle large volumes and a wide reach, which enables it to keep its costs low. A low capex requirement, a zero debt policy, and hiring from only local medical colleges allows it to reduce costs in its support functions. Moreover, date commitments over longer periods are due to high volume figures, and this leads to efficient procurement of reagents, which lowers its unit cost. It lowers its cost again in operations based on the asset-light franchisee model, a hub-and-spoke model, and automation at such labs. Moreover, the overnight delivery of quality reports and a targeted direct with major competitors, we believe that this margin is set to clock a 25% CAGR in the future years based on its expansionary policy. Under this expansionary strategy, 20 RPLs are supposed to be set up in the forthcoming years. Each of these RPLs will only come up in regions which will see a collection of at least 3,000 to 5,000 samples per day. Tests are also being shifted towards these RPLs, which will reduce average logistics costs, and expansion in capacity will result in benefits of non-binding reagent procurement. Another 1,200 new franchisees will help in pushing the Aarogyam brand. Thyrocare has a well-diversified portfolio of 198 tests across its three businesses. The preventive and wellness care market is expected to reach up to 9% of the 616 billion diagnostic market in FY18. This is what Thyrocare is gunning for. Internally as well, it targets to increase its revenue share to 80% from Aarogyam. Aarogyam currently generates 60%, contributes 60% to the PAT margin, thus signifying a strong growth in profits.
For us, is risk-free rate which we have taken as 6.10%, which is 10-year government yield, and a market risk premium of 8%, which we obtained from the reports from various analysts like Ram Thornton, Navotran. Beta would took at 0.52, which is the monthly and weekly average based on the industry, which comes at the cost of equity of 10.85%. For the growth assumption, for the back forecast, we take a 10-year period, 5-year for the high growth and 5-year for the terminal, and rest of the period for the terminal growth rate. We divide the sector into various parts like Aarogyam, thyroid, non-thyroid, each particular sector's growth trend, and Aarogyam, which is the